Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. We're back from our 1 week hiatus on the Energy Desk, sitting here on December 6th, just shy of midday Central. How's it going, Zane?
Good. Great Thanksgiving. I hope you had
great.
one too.
It's great. Lots of food, lots of family. That's all it's about.
That's why it's one of my favorite holidays, that and the 4th of July. There's nothing external other than good times with good people and good food.
Exactly. Yeah, and have a few updates in the kind of 2 weeks since we last chatted. I think it'd be maybe a good one to start with this week's OPEC meeting and some of the news that came out after that.
Let's do it. I want you to cover the headline numbers, and I'll follow you up with some subjective thoughts on what it means and what the market thinks.
Yeah, so biggest one I think that people are paying attention to is they just agreed to extend one portion of the voluntary cuts through the first quarter of 2025. So that is the 2.2 million barrels per day of voluntary cuts. And then we have another 1.6 million barrels per day of voluntary cuts extended till the end of December 26, and extending the kind of overall quota restrictions until December 31st of 26 as well. So it's kind of the headline number there. And I know that there's some pieces where we still have people overproducing. You have some specific kind of approvals or I guess exceptions made for people like UAE starting in April that maybe you can dive into, but let's go from there.
I think before covering who's doing what and what are their individual roles and meeting this latest and greatest OPEC expectation, this is like a really interesting exercise in the market expectation being out long enough that once it gets proven true, meaning expectation is proven accurate, there's this apathetic response like, oh, that's exactly what we expected. With several of our clients this week, we've brought that up, and I guess repeating for some, the color being, it's an interesting thing. If you'd ask somebody 45 days ago, 60 days ago, hey, I just heard OPEC's going to extend through Q1 of 25. What do you think that means for pricing? I imagine if you asked 10 people, 9 of them would have said, well, we're probably $10 higher. And here we are with TI trading sub 68 again, Friday, December 6th, and Brent looking like it's wanting to make a run at 70 support. So the expectation, this is what we think is going to happen, and it does, and there's no reaction. And then when you look at that versus the actual numbers, it's pretty stark. So as recently as September 5th, they put out their guidance of when they were going to be, by month, what it was going to look like when they began bringing barrels back in October. And then, of course, we've had a subsequent 1 month delay and then a 2 month delay and now a 3 month delay. I don't know. I guess in some ways that means the next one is a half year. And then after that, it's a year. And then after that, it's a decade. I don't even really know where this is going at this point. But the absolute numbers. So the latest OPEC release, cumulative production from Algeria, Iraq, Kuwait, the Saudis, UAE, Kazakhstan, Oman, and Russia, the voluntary cut crew, 30.42 million barrels per day for Q1. That's what the stated numbers were in the September release for October and November. That got kicked to December. And so that level versus where they now see end of 2025, 31.65 million barrels. So up 1.2 sequentially from March through December.
So 30.4 to 31.6.
Yep. So that, a significant increase, clearly. But when you go back to what they were suggesting in September, that change from January of 2025 to December of 2025 was up 2 million barrels. And then to take it a step further, if you go back to what they were predicting for October and November, that first delay 30.46. So a whopping 2.4 million barrel per day increase from what said DEES 25 versus OCNOV 24. So a material haircut for the expected flow of OPEC barrels in 2025. And then, like you mentioned, it's extended out through 26. The latest data from OPEC has them getting to the 32.88 million barrels per day. They lump it all together in a September through DEES Q4 plus one. But it's relatively gradual. You don't start to see the really chunky increases until after Q1 of 26. So I think the message is clear from OPEC. We're not done playing market police. Now that can turn on a dime, and in some, a bit of a perverse way, we've mentioned this before. If Brent were to fall to $65 a barrel, would they delay further? Would they extend cuts? Would they make cuts even deeper? Or would they, in fact, just say, well, if this is where we're going, I guess we got to hang on to market share because we do have cash flow needs like every, public or private producer in North America. So if we are to say rally $10 and we're back in the low 80s, it's probably a measured slow return. It's interesting times to have the market completely shrug off what is a significant change to global supply in 2025. Now, next up and on deck, and I will set the mic down for a minute. Sorry, I had a bit to say.
Yeah, I actually have a follow-up question because I think in one of the DMUs this week, you discussed some of the non-OPEC supply that maybe relates to the sentiment reaction.
That could be, our comments were just reminding readers, listeners, that the combined growth this year from Canada and Guyana, a little less than 500,000 barrels a day. When you think of 500,000 barrels a day of supply growth relative to the, I'll call it the long-term historical norm for global demand growth, that's a little less than half of it. So these tiny two countries, that produce collectively less than 6 million barrels per day are capable of eating up essentially half of global demand growth. By the way, the DOE is predicting 1.1 million barrels a day of demand growth in 25. OPEC, as is usually the case, is a bit of a loftier, kind of talking their own book. Of course, if you're so highly levered to the supply side, you're expecting demand to be very strong at 1.5. So a replication of Canada and Guyana's growth could eat up 1/3 to 1/2 of global demand growth in 2025, which is really interesting. It's, giving zero credit to Mexico, Brazil. Iran, is there more? And then even inside of the OPEC numbers, you mentioned it earlier, and I don't think today, maybe we'll cover every member of the voluntary cut crew. The UAE is still definitively producing more than they're supposed to. So too is Kazakhstan. When you look at the latest release, Kazakhstan is not supposed to get over 1.6 million barrels per day, period, through the end of 2026. When was the last time they produced more than 1.6 million barrels per day? August of 24. So it's an interesting setup. I mean, and then the place I was going to go next that I think the market should be gearing up for, and maybe is a bit of the apathy for right now. Both OPEC and the DOE, OPEC in their monthly oil market report and the DOE in the short-term energy outlook, both of those will be released, I guess, kind of inverse respectively, non-respectively. I don't know how you say that. The DOE, I believe, is on the 10th and the OPEC MOMER is on the 11th. So we'll get some new demand forecasts, and it's possible the market's just looking out and saying, well, why would I expect anything less than another downward demand revision?
Yeah, especially I think economic picture is in focus, and there's been a couple more promising data points out of China, but I think generally people are reticent to latch onto those considering kind of a wave of disappointment over the last year and a half-ish. So it'll be interesting to watch how China's economy reacts to stimulus that was released in September, early October, and maybe how that passes through, if it passes through. So a lot of unknowns on the economic front, even when you look at the US. So Yeah, I think that's kind of a nice breakdown of OPEC. We'll look for that new data next week for the DOE and OPEC's MOMER on
Doing up next week's
exactly
podcast already. Right?
At least one of them.
Talk about.
So yeah, I think looking closer at the U.S. natural gas landscape, I think this was kind of an interesting past couple of weeks pre-Thanksgiving as we started November and got into late November, kind of the weather shifts and how the market responded and kind of since then responded as well. So I think you have some nice notes for people there.
Quick headlines. The past 2 weeks, 22 HDDs colder than normal. We get this cold shot in late November. The market gets really excited with the December contract, NYMEX contract expiring at 343. And so it was cold, and then it wasn't. In a matter of just a few days, the market comes back from the Thanksgiving holiday, and the heat wave is on again. The next 2 weeks are forecast, as of this morning, to be 33 HDDs warmer than normal. Plus 21 late November, minus 33 last few days of November into December. So the warm is warmer than the cold was cold. And then panning out a little bit bigger picture. What has the U.S. gotten in the way of HDDs from the beginning of withdrawal season, November 1, through the forward 15-day weather forecast, which takes us through, I believe it's December 20th. Yes. So Novi 1 through December 20, assuming the forecast is accurate, that would be 96 HDDs warmer than normal. As a general rule of thumb, multiply that number by 2, and that will tell you how many BCF of demand you've lost. Arguably, the coefficient's probably at this point at 2.5. But to be conservative, you could say that we've lost at least 200 BCF of demand already this winter. How does that compare to the same period last year? That same Novi 1 through December 20 period last year was 116 HDDs warmer than normal. So not as warm, not as mild, not as bearish a weather. But if you take out that one tiny little 2-week window, and honestly, it's really just 1 week, it's exactly the same. We're starting the same. So in some ways, I think that's what the market's keying off of. There is effectively no risk premium in Q1. We're at well below $3 in Q1, have struggled to even hold up above 290. And at the same time, there's been some actual recovery in longer dated tenors. So I think the market is super keyed up on what weather forecasts do. And for market bulls, there was what appeared to be a path to seeing some convergence towards Euro weather models, which were the cold outlier versus the GFS. That's all but gone now. The Euro has migrated towards the GFS. And so at this point, from a weather perspective, market bulls have to look to the other side of the pond. And maybe with that, I'll give it to you, because the weather forecast in Europe right now is colder than normal over the next couple of weeks. And it has been a cooler than normal start to the winter, particularly in Eastern Europe. And with that, what are you seeing going on with?
So as you mentioned, a little bit cooler than normal. Also winds far weaker than normal. I think the numbers that last calculated were about 25% prior year levels between kind of October and November for wind speeds. And so, that puts a lot of pressure on the wind dominated generation stacks in the EU. And then, the compensatory backup gas-fired generation. So kind of EU altogether, looking at kind of October 1 through December 5th, inventory changed about 440 BCF, so down just under 12% for the season so far, which on the minus 440 is the second largest depletion since 2016, which was a 500.54 BCF draw between October 1st and December 5th. And, I think just kind of a quick aside is what's kind of some of the drivers of that. I think really we're looking at Germany and Italy, kind of the gas-fired generation having to compensate for, again, one of our favorite words, the Dunkelflaut. So very calm winds and cloudy weather. So takes out wind, takes out solar, having to compensate with coal and natural gas. But I am curious, how I think there's plenty of things that we've talked about in the last week when we've just been chatting, but how that relates to, say, TTF and then maybe Asian markets as well, kind of in the next little bit of winter here.
With a colder outlook, there's certainly reason to believe there could be another gap higher for TTF, and then JKM will likely have to follow it, because if it costs more to get an MMBTU to Asia, and Asia's not producing any of them, so they got to get them from somewhere else. We're still pretty surprised at how tight those two are. For context, January TTF is currently trading $14.46, and January JKM is $15.07. So essentially on top of each other. Could TTF continue to move higher? Absolutely. I think one of the key points to be made here is Europe doesn't really know what cold weather looks like without Nord Stream MMBTUs flowing into key demand centers, particularly in Germany. And then, there's another, I think, interesting read when you go back and look at that period that you're referencing, October 1 to December 5th, 2016 versus October 1 to December 5th of 2024. That 2016 period was significantly colder. The setup was the same, where much of Western Europe or far Western Europe, think Spain, Portugal, maybe a bit of the UK, I guess that would be more, still Western, warmer than normal. But the magnitude of the cold in 2016 was far greater. And so I think that highlights the issue that could be at hand with the lack of flowing Nord Stream molecules. In other words, Europe could, with just as little as another 6 weeks of cold, be back on the verge of creating the next global BTU crisis. Yes, you heard it first here.
Yeah, and it's pretty remarkable to see the speed of those inventory depletions just starting the year in 2024 at the highest ever after withdrawal season, and then you are quickly approaching the 5-year median. I think they might actually have dropped below that and quickly approaching the 10-year median as well. So definitely an interesting one to watch. And one of the ones that we've discussed here previously that has kind of a questionable impact on Europe, but is top of mind, is how the Gazprom Ukraine transit agreement will affect, kind of just broader block inventories in early 25. And it's, as we've discussed previously, just about 5% of total European supplies, and doesn't really feed into Western Europe, mostly looking at, say, Austria, Hungary, and some of those Eastern/Central countries. And I don't know, do you have any thoughts on where that goes, when that expires, what happens?
In some ways, maybe I'm a bit of a naysayer on the excitement from these events. I mean, when it comes to something like power or natural gas, essential for, at this point, human existence, yes, you have to acknowledge that we could not live without it. We don't know how anymore. That those problems get solved. When the Russia-Ukraine conflict first kicked off, that was one of the ideas. Like, there's going to be no access. Like, no, there will be access. It will get sorted out, whether it's through back alleys and back channels or deals get done. I don't know that it really changes anything, but I'm admittedly, like I said, a skeptic on there being some significant market shift because of it.
Yeah, it will be certainly interesting to watch. I think what would be nice to do, we'll just jump to kind of the government situation that's happening in Europe post US election that we highlighted on the week, I guess 2 weeks after the US election on the Energy Desk, but talked about Germany's leading coalition, the Traffic Light Coalition, led by Chancellor Scholz, collapsed imminently. And one of the main drivers of that, people are fed up with paying for expensive energy and kind of this Energiewende energy policy that Germany has really pushed. But this week we had France follow suit with their government collapsing. And now there's kind of this question of, I guess, how quickly will that be resolved? And one thing that I think probably I would assign a low probability to, but one to just point out for listeners to kind of keep track of is how does that potentially affect the state-owned EDF, who manages French utilities and supplies about 70% of France's electricity and about 60% of intra-Europe electricity exports, the main buyers of which are Germany and Italy. So I think if, there's a extended issue with the French government and some funding is affected for EDF, I would be definitely expecting to see some impact for German and Italian natural gas demand. But maybe you have expanding thoughts.
Yeah, I think on that last topic on the EDF issue, government-owned utility, I guess the logical read-through is, well, you're a bigger credit risk now, so you're going to have to pay more for it. And then ultimately that just gets passed on to Germany and Italy. So I think my take would be you're seeing this ripple effect across Europe where German policymaking decisions end up affecting neighboring countries, even somebody like Italy, which, I think on the surface, like, wait, we're not even involved in any of this. How are we impacted? Well, if you don't make your own stuff, in this case, power, then sorry, you are affected by what Germany does and what they get from France, and because you're just kind of picking up the scraps along the way.
It's been pretty remarkable to see the impact for German industrial too. Just a quick data point on that I thought was pretty fascinating was that German industrial production is down 21% relative to the period before the Russia-Ukraine invasion. So just the impact of expensive energy for Germany as Europe's industrial hub, all of the energy-intensive sectors are really kind of paying that price. So it's pretty remarkable, probably heading towards kind of that recession outlook there, if not already there for the last, 2 years for German industrial specifically. But
the thing that's fascinating to me on that is, just pure supply and demand. I don't know, Econ 101. If prices are high and that's what discourages and pressures the industrial sector, and, there's a long laundry list of manufacturers who have left, slowed down, decided not to open up. Correct me if I'm wrong, but higher prices equals lower demand equals prices stabilizing, but we're still not there yet. That thing to me is like the really frightening thing is we go through the BTU crisis. We know demand in Germany specifically, but across Europe is weak. And yet we're still talking about elevated power prices, elevated gas prices. I don't really know where the end is or, what it really looks like. Maybe that's even an interesting segue to the next global conflict or global calamity topic, because I think in this, correlation would be, is there a path where what decision making has occurred in Europe actually requires the participation of non-European nations, NATO, all Western powers? It sounds crazy, but would Europe just be allowed to outright collapse? If there were, 2-3 cold winters in a row, what would possibly unfold there? And so with that, let's go to a place a little bit to the southeast where things are not cooling down. Things are heating up.
Yeah. So this has been just a rapid and kind of fascinating one to see unfold in Syria in the latter half, kind of the last 10 days, week of November. You just had this kind of rapid deterioration in various regions within Syria. So many different factions to pay attention to. Kind of the main concern now is the collapse, I'd say imminent collapse of the Assad regime in Syria. And that has downstream consequences for, many players, because you have Russia, who's been active in Syria. You have Iran, who uses Syria as one of their main supply routes to ship arms to Hezbollah. You have Turkey, who is semi in favor of some of the rebel groups that are kind of going against the Assad regime right now, because then that gives them more freedom to go and target some of the Kurdish rebel groups that are along their border. Then you have US sponsored / US supported groups in the region that are either active or not active. And then you have kind of the ISIS and HTS, which is, I guess, a relation to Al Qaeda, that are all interested in this potential new power vacuum that could open up in Syria, which, as we were discussing earlier, is not necessarily a nation that has a lot of crude-centric infrastructure that would be immediately at risk. But that power vacuum, I think, is what I am watching, where, say, you have ISIS able to come in and take more power for different regions that they were kind of pushed out of by the U.S. previously. And it could be any number of players. But what that maybe does for Iran or Iraq in the region, because it is just proximal to so many different crude-producing countries that are sizable and would have a material impact on kind of overall supply, especially with the broader, I guess, neighboring conflict risks that we have with Israel and then Russia and Ukraine as well. So I think there's a lot going on.
I think those two you mentioned, it like creates this really interesting cross section between Russia and Israel, right? Like there's like these two separate things going on. There's this Russia-Ukraine issue that we've had now for a couple of years, I guess, more. And then we've got the Israeli and Iranian conflict. And now all of a sudden, do you create this stage where you've got Russia and Israel at odds? And then what say you, U.S.? Have fun, new president. Look at what's just gotten cooked up.
Yeah, it's a messy.
I mean, are we back to, man, I think the point you made is a really good one. Is like, while there is no oil there, the players in this are, in many instances, highly levered to the price of a barrel of oil. Russia, Iran, Iraq, the Kurds within Iraq. Yeah, it would lead you to believe like there's got to be some geopolitical risk priced in. Reminder: cruise trading sub 68. I think the lesson learned here is, until somebody literally has infrastructure blown up, it's just an interesting storyline to follow. Interesting, not as in we like it. This is such an unfortunate situation for the civilians. This is that side of the world has gotten its share of unrest. That's for sure.
Absolutely. So I think that one is in flux, but the speed that I guess the situation is changing and how things are progressing towards Damascus, and that all could change by the end of today. So it'll be interesting to see how that does evolve between now and when this episode comes out, but definitely one that is worth watching. And I'll put a link to this in the show notes for listeners, but there's a pretty interesting just kind of background report that I was looking into that I think might give people just context for what's been going on over the last week and get you up to speed. So yeah, we can kind of leave it there.
I think it's great you're doing that. In my personal opinion is, with all things Middle Eastern, you need to read them 3 times before you really wrap your head around it. So I think that's a great ad. I have one last, just maybe even as a cliffhanger for next week. The South Korean government is having its own issues too. Maybe you want to comment on it. I just want to flag it because there are issues in South Korea as well. And we talked about European weather, but it's been cold in Japan, and South Korea being right there in the ballpark. Maybe geopolitical risk is coming to the gas.
This was kind of another one of those, just came out of nowhere in some ways. I guess people didn't really expect it to unfold in the speed that it did, but you have this surprise martial law attempt that, there's kind of questionable information on all fronts on what exactly happened, but now there's kind of this insurrection investigation that's going on, and, just a lot of unrest between people, government, different government factions. And the main consideration that I'd really just point out is what that does for perceived risk and the won, so currency risks for South Korea. And, again, having to come in and do currency intervention to stabilize the currency. I think there are a lot of downstream effects from this that if they kind of go further down this path of instability, what that might mean for their import-export kind of relationship with even the US and kind of downstream from there. But, I'll just leave that one as a very high level because there's just not very clear information that is coming out that I think
maybe by next week, maybe there will be some more clarity.
So that would be interesting. And then I think one of the last ones that I thought would be a good one for listeners to just kind of keep in mind. We had another one of the tech giants come out this week saying that they really want to have some nuclear built, and hopefully by the early 2030s. This time we had Meta Platforms, formerly Facebook, come out and say that they are going to solicit between 1 and 4 gigawatts of new nuke capacity by hopefully the early 2030s, and kind of some flexibility on who would be developing that, trying to figure out who can build that. But in line with that, one of the questions that I really wanted to dig into was, okay, so we have these very aggressive, or I guess very ambitious timelines for building out new nuclear capacity because it's, as we talk about, it has some of the best attributes for reliability, and it's kind of your always on 95% capacity factor, better than everything that is in the US generation stack, but it's all very old. And kind of just putting that into context for these timelines for big tech, it's kind of an interesting time because you have the history of U.S. building nuclear. We can say that, in the entire history, so since 1951, where does the U.S. rank for its ability to build out nuclear quickly? And it ranks 21st out of 25 for the median reactor build time, which was about 6 years. And then it ranks 25 out of 25 for average reactor build time. And that was about...
That's not fair. That's just because of one reactor took 60 years to build it. But 21 out of 25, that's why that one's so long. But, I mean, that's just a pretty, awful...
It's not, not very supportive.
Homer Simpson and his buddies are not great at getting these things built. I mean, that is pretty frightening with the desired addition. I mean... What is it like lately?
Yeah.
I mean, has it changed in any of these ones?
And that's kind of the interesting thing because, that's looking at the entire history of the U.S. reactor fleet. And when you isolate for, I guess what I would qualify as modern history, so since 1990, we've only constructed 2 reactors. We've talked about that on here before. But for that qualifying period, so after 1990, there's only 11 qualifying countries, and the U.S. ranks 10th out of 11. So median timeline for just 2 reactors, very small sample size, is 10 years. But I think the more interesting one that I just kind of threw into one of our Intel briefs this week was that this metric that I call build efficiency. So how much capacity are you constructing per build year? The U.S., I would have expected to be one of the most efficient. Again, ranked 7th out of the 11 qualifying countries since 1990. We build about 125 megawatts per build year, so active construction. And that compares to Japan, who's the number 1 ranked for, I think, all of these metrics actually for every period. Japan builds 337 megawatts of nuclear capacity per active build year. They take about 3.5 years to build a new reactor, which is pretty incredible. And I guess this is kind of the question that came up, especially right now as we have President-elect Trump coming into office. One of the primary things that's been interesting to watch is this Department of Government Efficiency, and be interesting to see how this actually plays out and what they can get done. But the primary goal that DOGE, as they call themselves, is to remove this burdensome regulation from the U.S. economy, just free up the speed of capitalism. But that objective kind of enters some murky water when you're talking about nuclear regulation and the NRC. And so it'll be very interesting to watch. One, does the Department of Government Efficiency come into place in 2025? And 2, will the NRC even make it onto their list of regulatory bodies that they're going to try and improve this efficiency? So plenty of unknowns. I don't know if you have any thoughts on that.
Well, they say they're going to get rid of departments altogether. Maybe they just say we need to get rid of the NRC. I'm just listening along with you. I kind of find more of the funny anecdotal points of interest of what is this would be a fun one. I'm sure you could track this one down pretty easy. What are the percentage of big tech company employees who drive electric cars versus, say, I don't know, another non-oil and gas related industry? That's not fair. My guess is it's pretty high. So build me some on-site nukes. I want my free gasoline out front of my workplace.
And with that said, I think it'd be awesome to see kind of this tech industry that I guess I would qualify as it values speed and efficiency and just getting the things done that need to get done. And it's pretty obvious that this power problem is going to be a limiting factor for new technologies like AI or data centers. If people are really wanting to adopt these technologies, which I think they will, how are you going to build it out? And we talked about on that webinar that people can go and seek out too, but this concept of the 2 years or some really long timeline to build out a hyperscale data center or supercomputer. I think one of the interesting points that happened this year is kind of like that 4-minute mile concept where everybody's saying, oh, we have to wait, a year and a half, 2 years to build out these hyperscale data centers. Then Elon Musk comes in and builds one in 19 days, and it's the world's largest supercomputer. And so that kind of fractured people's perspective in that. So I think that there is a lot of this pent up demand. I think there will be some really interesting, solutions that come out as you have this tech industry trying to solve their own compute problem and what that does for power. I will say though, that when you look at the track record of the US building out nuclear,
I would say the one thing that I really hope is considered, could we be more efficient? Absolutely. Should we be? Probably. And I'll use your analogy there because I think there's an important takeaway. The 4.5-minute mile. How many athletes in trying to break that barrier significantly injured themselves to the point where they were not able to compete anymore? Probably quite a few. You don't know their names at all, and you never will. And the collateral damage, near zero. The country, like you said, that ranks highest on this list for efficiency also happens to be the country that's had the worst nuclear disaster
in the modern era
in the past 20 years. So I'm all for efficiency. And in this case, with nuclear technology, I would hope that the Doge is equally as mindful of the collateral damage that can occur to people that have no interest. If I'm not running a 4.5-minute mile, then I don't care if you do or you don't, and you blow your knee out or you don't. Yeah. If I'm next to wherever you're building this nuke and something goes wrong,
that's when I have a problem.
I am impact, and I am a proponent. Yeah, I'm a big proponent of nuclear technology. This is not a anti-nuke bias. I think it is a great thing, and doing things faster.
I think that's really the takeaway that I see is that it's the risk associated with the enrichment capacity, and not even discussing the supply chain issues that we've highlighted, where you don't even have a domestic fuel supply chain that is capable of expanding that quickly without necessary investment. But I think really I just say that the odds are kind of favoring longer than anticipated, and that to me spells kind of this likely pivot to existing technologies like natural gas that have quality infrastructure and can be scaled up. And the U.S. has a whole lot of supplies. So that'd be kind of just the one to watch.
Well, and you gotta pay somebody to build it too, right? So does that mean higher power prices, which would then mean higher gas prices? So note to all the listeners, if you've got power exposure, whether direct or indirect, if you're an oil and gas producer, you're exposed to the price of power. All of that should be contemplated.
Yeah. Well, awesome. And I think, again, we'll throw a bunch of data, charts, and some of these interesting links into the show notes. Definitely go check those out. And we'll have, as we mentioned, some more stuff to talk about crude-wise, and I'm sure plenty of other geopolitical things next week.
Alex, great being with you. See you next week.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.